We are making it happen with the mini cam today. Just wanted to get an update out there. Was planning on doing this last night, but just having too much fun with the family and couldn't pull myself away. So let's take a look at what's going on right now. There's a couple of things that I think are super important to pay attention to. One thing, if you haven't seen this, my most recent video about mortgage inquiries. Do mortgage inquiries affect your credit score? Do they hurt your credit score? New information has been released about this. This is what I've been telling people for a long time. The credit bureaus were headed this direction. Mortgage inquiries essentially now omitted from affecting your credit score. Check out that video if you want the full explanation. The link to the articles from the credit bureaus and everything is all in there if you want to check that out. What we're going to look at today is a couple things. What's going on in the news, what's going on with stocks, what's happening in the mortgage interest rate market, and is it possible that interest rates could go much lower. There's a lot of people who believe that that's the case. There's a lot of people who hear that the Federal Reserve is going to keep rates at zero, therefore mortgage rates should continue to go lower. Not how it works. But today, I'm going to dispel the myths. I'm going to show you how it works. How do rates actually inch lower? So like we know how home values, let's say, go higher when someone's willing to pay over the appraised value, and then that creates a new comp. And now the next person who buys a similar house is going to pay that price or more, right? When the market's going up, and the opposite when the market's going down. But how does that work for mortgage rates? And is the current environment that's being created by the financial markets, is it conducive for rates to go that much lower? And I'll show you how it's possible both could happen, and I'll let you decide which one you think is more likely. So let's take a quick look here. We're going to jump over to, I'm doing this a little bit differently today, just trying to see which one of these pieces of technology is going to actually work. Couldn't log into Zoom today. Zoom fail. But I've got other options. So Dow is up big today. This does not help mortgage bonds. I'll show you in a second. The reason why we look at the stock market is because essentially what we're looking for in lower mortgage rates, which I believe is the key not only to economic recovery, but to the housing boom to continue, which I think is super important for the economic recovery. This whole thing feeds itself. If we see much higher interest rates, that could crash a lot of different things. The Fed is working for us. They're on our team here, but we need to know what's going on and how the pieces are being moved on the puzzle board. So right here, the Dow is up this morning, 400 points, which was interesting considering how things finished last week and also just kind of what's going on. But I'll start to show you why. You're going to see here, in a lot of the news, if you look at the news, you're going to see tons and tons of coronavirus news. Tons and tons and tons of coronavirus news. Is it that big of a shock after these protests that have taken place all over the country that we're seeing a spike in coronavirus cases? Doesn't seem like it. If this is a legit thing that's going on, which a lot of people are still skeptical about, we have noticed that the death rate and the mortality rate and those things have really, really, really declined. We don't know if that's antibodies or what's causing that, but there are more cases. There's lots more testing going on. There's still a lot of people gathering in mass gatherings for protests and things like that, which weren't advised previously by the CDC and so forth, but now seem to be okay. So this is the big news for housing today. Pending home sales spike, a record, okay, huge. Home buyers have flooded back into the market. What happened was coronavirus kind of paused things for a second, and then ultimately that pause was just pent up demand. People were just, the race car in the red, just ready to get in there. And so as soon as they felt comfortable, boom, they jumped in. Sellers didn't jump in as quickly as buyers did. Sellers not as fast. That's what's caused the spike, I believe, here, is that we have just such a frenzy atmosphere that if you're a buyer, you either have to get out of the way, you have to get on the train or get off the tracks. You can't just toe around. You can't stick your toe in the water of this real estate market. It doesn't work. The only way that you're going to get a house in this particular real estate market is if you are committed from the very beginning and you go after it. So if you're sticking your toe in the water, you're not getting a house. And people realize that. So you have to pick one or the other. We don't have the lazy buyer. We don't have the ho-hum buyer in this market. They're just dead. They're just a waste of time for themselves and for their agent. The reality is it's the buyers who are ready to get after it, and people will learn. People adapt. Human beings are very adaptable. We adapt to these scenarios. We need housing. It's a carnal need. So when we decide that we need new housing, we will go after it, and that's what's happening right now. So you see this very, very good news, and this is a big part of why you're seeing the Dow up today, still over 400 points. A big part of it, because everyone knows in the financial markets that housing is a huge indicator not just of what's happened, but of what's happening. Where is the sentiment? How do people feel about this? There's a lot of crazy stuff going on. And by the way, it's an election year. So that said, let's roll over to mortgage bonds. This is brought to you by mbshighway.com right here. Barry Habib, who provides us with this information. So if we look at this, we can see, and these are daily candlesticks. So each one of these candlesticks represents a day. And you can see now we've just slowly crept higher over the last 1, 2, 3, 4, 5, 6, 7, 8, 9, let's call it 9 days. We've just crept higher nicely. Had this huge move here. There was a rollover right here, which was the only reason that was down. So this is actually a bigger arc if you look at it. Then we had a pullback to the averages. Right here you see the moving averages. That's what these lines are. About to get another positive crossover right here, I believe, with the 25-day. And we'll probably pull back to that here at some point. But then the question is, can we spike up above these previous highs? Can we get above this level here at 104, 424, 56? Why does that matter? How do mortgage rates go lower? This is the question I'm going to answer right now. So you'll see that we're looking at the 2.5% mortgage bond right here. And you have to know a little bit about how bonds work in order to understand this, but I'm going to make it as simple as I can for you. When a bond is issued, it's issued with two things. Okay, it's issued with a price and a coupon rate, let's call it, or a yield. So these were issued, every bond starts at 100, which we can barely see on the charts, way down here. Okay, that's 100. That's what this was initially issued at, 100. And CDs and other fixed income work similar to this. So if you bought it the day it was issued, or if you got it at issue price, even if it was later, you got it for a price of 100, which means $100 buys you, one. Let's just consider that the concept. And then you got 2.5%. So you're guaranteed your 2.5% yield on this mortgage-backed security. Well, 2.5%, if you go and you looked at the fixed income page on Fidelity or Scottrade or Charles Schwab or wherever, you're going to see that it's very hard to find 2.5% annually on anything other than junk bonds, which would be like BBB rated corporate bonds, okay? So you can get higher than that on that, but there's a lot more risk on that than there is in like a Fannie Mae or Ginnie Mae mortgage bond. A lot less risk here, a lot less. Now, what happens though is you'll see as this price goes higher, well, what happens when the price goes up to 104? Well, then you have to do a little division there, right? Because now I'm paying 104. It was 2.5% when I paid 100, but now I'm paying 104 and I'm paying 4% higher on the price. So my yield is actually yet less than 2.5%. Even though I bought a 2.5% coupon, I'm getting less than 2.5%. Interest rates going down because bond prices going up. Make sense? Now, what happens is they start issuing these new coupons. So you have a 2.5% here, and the price goes up so high that all of a sudden it's paying, let's say, 2.2% instead of 2.5. Well, then it makes a whole lot of sense at that point to start issuing 2.25% coupons, doesn't it? Clearly, the market is willing to pay for that, so they'll start issuing those 2.25% coupons, and then 2% would be the next one. If those prices get driven up above 100 and stay there for a long enough time, they'll issue 2%, and then 1.75 and 1.5, and that's what's happening. This started, several months back. We were at like 3.5% coupon, and 3.25%, and then 3%. We were on the 3% coupon for a long time, and then it seems like we just sort of jumped right to the 2.5. And I don't know if that's just because how Barry's following it or whatever, but they go by 0.25%. We've seen that there most likely will be a 2% issue. Could it get to the ones? It could. What would it take though? Because why are bonds in such high demand? Well, we talked about how other fixed income options are really limited, but also we've got a scenario here where the Fed is actually buying. So the Fed is buying billions of dollars a day of mortgage bonds. So if they're not in the game, man, we're pulling back here big time. So the question is, can mortgage rates get into the ones? A lot of people have been asking me, hey, can mortgage rates go like much lower than they could? But what we need though is we would need the stock market to go down. See, the problem here is when the stock market has days where it's up 1.6%, this idea of buying a mortgage bond that's going to pay me 2.5%, and in this case, if I buy this coupon, much less than that in a year, when people are over here making 1.6% in a day, you feel like you're missing out. I mean, you talk about FOMO. There's no place where FOMO is greater than Wall Street. Any fund or investment manager will tell you this. anytime there's something breaking out, you always wish you were in on it. Like, golly, how did I miss this? And your investors are going to ask you, do we own that? Do we own that? So, if you're just hiding out in mortgage bonds over here, you're missing a lot of big gains right now. I mean, if you've been in bonds for a while here, let's say since the recession crossover took place in bonds, once we had the yield inversion, which I won't go into too much, but once that took place, that was like, okay, here's the big red flag that's getting waved. Hello, we have a recession on the way. And that started happening at the end of last year. This is when Barry Abib, who provides this information for us here, MBS Highway, came on my radio show and said, I'm buying bonds, Derek, not for the yield, but for appreciation. He was buying bonds because he could get bonds like these right here at 99, 98, 97, and he wanted to just catch the appreciation, wave up, wave higher. And I don't know how much money he made, but it must have been a fortune because he bought those bonds when the price was so low compared to what it is now. So what he was telling us was, listen, this is what's going to happen. And he was 100% correct. What we didn't know at the time is that the Fed was going to be a huge buyer of bonds, which they are. Will that continue? If it does, I think it will. Unless the Fed really gets distracted in some other direction, which would have to be a major, major catastrophe for them to just reallocate and not be involved in the mortgage game. I think most likely the Fed will stay here. But will we continue to get enough other demand in order for those coupons to roll over and for us to get to a point where we've got like 1% Fannie Mae, UMBS, 30-year fixed bonds for sale, and people are buying them? That's what it would take. Because right now, as you can see, 2.5% coupon, there are rates now that are on the rate sheet that are in the twos and even in the low twos for VA, for example. Locked my first 2.25%. It's not par, it costs points, and sometimes it doesn't make sense for people to pay points, sometimes it does. So Derek Evans, NMLS 155010, by the way. So, it just depends on whether or not we're going to get the continued action from the Fed and whether or not we're going to see the stock market take a little bit more of a breather. If the stock market, 25,000, by the way, is a really, really crucial battleground number. We closed just above this on Friday, which is why I had a feeling we would go higher today, because that's really a big number, 25,000. It's a round number. They like to be battled with the Dow at these really round numbers, and this is no exception. So 25,000 is a big, big number. If we close below 25,000, we could see more action in bonds. But until then, we're just kind of hoping and relying completely on the Fed just to keep interest rates where they are right now. Not that we should expect them to go much lower. The banks have some room, though. The banks got hit hard by forbearance and a bunch of other crap, and they've had to keep rates a little bit higher to help pay for all that mistake that took place that was completely out of their hands. And I feel for them, and I understand. There's still room for rates to come lower, even if bond prices stay exactly where they are, because there's a little extra margin out there right now. That said, that also happens when there is lots of volume, when you're seeing record volume, record refinance applications, and high demand for purchase applications. When you see that happen, you're going to see the banks have to be so competitive. They're not out there fighting for the business as much. They've got so much of it they don't know what to do. If there's a little bit more competition, that would also help rates. But see, it's a self-fulfilling prophecy. When rates go lower, then everyone gets busy, and then no one has to lower the rates. So it's one of those things, it's such an ebb and flow. If you're looking to get the lowest mortgage rate, and I'll just give you a little bit of advice on how to tackle this. First of all, if you're looking for the best VA rate, 100% give me a call. And my information's everywhere. It's on this video. It's in multiple places. But that is my specialty, helping veterans buy and refinance homes to get optimal financing terms. That's my 100% specialty. But if you are trying to figure out, well, how do let's say I already have a loan, and I know I want to refinance, but I want to get just in the right spot. A good way to go about that is to go ahead and get your application in, get yourself in a position to lock your rate, and let your loan officer know, like, hey, I am willing to wait for a great rate. And I've got a list of people here today. I'm going to look. I just got the email that the lock desk opened up a little early today, which is interesting. But it is a short week, too. And in these short weeks, we usually see light volume. That was the other thing I was going to mention. If we're going to see light volume, we could get lied to by the stock market this week based on light volume. There's not as much traveling going on as there normally is. I'm traveling, though, and I know a lot of people are. We'll see. But we could get lied to by the markets. In other words, the market could be up huge this week, and it could make it look better than it is. But the stock market going higher is not helping mortgage bonds. Let's put it that way. So we don't want to root ever for the stock market to go down. I think that's un-American. You can bet on it. Don't root for it. We want the stock market to go higher. But in this particular case, if it goes lower, we won't be too pissed because at least we'll get those lower mortgage rates, which are just right there. I mean, they're just right there. It seems like for the taking. We just can't quite, we're just not quite there. But we're really, really close to, I think, a breakthrough potentially in mortgage rates to the downside. But that said, it may not happen. In fact, if the Fed exited stage left right now, mortgage rates will go way up really fast. So if you want to be in a good position to refinance, get your application in, ask your lender, hey, what do we need to do to lock? What do you need from me in order for you to lock the rate? And ask them to keep you updated on a daily basis with where rates are so that you can be in the know. And if they're unwilling to do that, fire them. Don't even do the application with them. That's their job. Okay, I know this is the job I do, so trust me. That's your job. Your job is to calculate payments for people who are pre-approved and who are looking at homes and they want to know, hey, how much is my all-in payment on this one? How much is my payment on this one? Your job is to keep people who are in the hopper waiting for a good lock to know when it's a good lock day, to keep them apprised of how rates look. This is your job. So if people aren't willing to do that job because they're too busy or whatever, the hell on with them. Get out. See ya. You don't deserve my business. Okay? So expect good communication from the people that you're working with. I don't care how busy they are. Expect good communication. If you don't get it, get them out. That's 100. They 100% owe that to you. So this is just I wanted to just download real quick what's happening, what's going on, where we're at with some of these really key places, both in stocks and in bonds. It is possible that rates could get worse a little bit here in the near term if the stock market has a really good week, which I have a feeling it's going to. I have the feeling the stock market is going to do really well this week. Rates may soften a little bit, but we're still really, really good. I mean, we're talking VA, good credit in the twos, high balance, conforming balance, everything's in the twos if you have good credit for VA. Growing up to $2 million if you can income qualify. And then on the conventional side, you're seeing rates get close to 3%. Some people are able to buy down slightly into the 2% range. I think that's really where it could pay off to hold out. If you have to look at your risk reward. If you are ultimately sitting there going, should I refinance or not? You have to look, what are you risking? Well, if you refinance today, you could save $100 a month. Okay, so that's your risk. If you wait and you don't pull the trigger on that, then your risk is, well, that could go away, $100 a month. So if you're in a situation where you could save like a significant enough amount of money where you're like, man, I could really feel that. I could use it. Hey, the $250 a month, that's enough to fund your kids' college. Or to at least give them a college fund. If you could save $250, somewhere in there, I really think you go ahead and pull the trigger, just because there's too much to risk. What are you going to get? Another $100 maybe if rates go lower? I think you go ahead and take that. And especially if you're saving $300, $400, $500, my goodness. Do not wait. Do not be greedy. Take that money to the bank. And hey, if rates do drop into the ones and it makes sense to refinance again, then do it again. But just make sure it makes sense each time you do it. Each time it needs to make sense within itself to refinance, to look at the costs that are involved. I share my refinance hack with you in a video that's on my page as well, and I share with all my clients too. There's a refinance hack. Aha! A hack that I know that some people are sharing out there who are number savvy. Not everyone is, and if you use this refinance hack, you can end up with what I call the trifecta, which is a lower balance than what you started with, a lower payment, and a lower interest rate. It is very doable. You just understand the mathematics, and if you can do that, pretty simple arithmetic, and you understand where all the money is coming from, then you will see easily how this refinance hack works. So contact me if you want more information about that as well. I hope this is helpful. I hope you will share this with your friends so that we can together make everyone smarter.